That was fun. Can you hear me?
Yeah, we can hear you, buddy.
Hello?
Hello?
I got ruined. I didn't even suspect it. I don't know why.
Hello?
Martin, I have a question. If Apple has all that cash stashed with them, why do they still have debt? Why don't they pay it off?
Hey, sorry, I'm back now. Do you have a question?
Yeah, I have a question. If Apple has all that cash with them just stashed away, why don't they pay away their debt? Why do they just keep the debt with them?
It's actually a great question. One of the reasons, so just think about it from your own perspective. Let's say you had cheap debt, right? You could borrow, how old are you? 20s, 30s? 10?
I'm 22.
Teens? Okay, 20s. If you could borrow $10 million, if I lent you $10 million with 1% interest right now, would you take it?
Sure, yeah.
Yeah, it's a very low interest, right?
Right.
And even if you had $20 million in your bank account, would you take it? You should. Because what if you wanted to buy something for $25 million? Right? You're rich, you have $20 million, but you don't have 25.
Right.
So you'd like to be able to have another 10. So you have 30 in cash with 10 in debt, even though you have 20 in net cash. But that extra flexibility allows you to, say, buy something for $25 million. If you could buy something for $25 million that's worth $500 million, right? You would make a huge amount of money. You'd make $475 million. And opportunities like that may come up from time to time, and the last thing you want is to not have that extra $5 million that you need, right? So what if the market crashed tomorrow, and Apple could buy Tesla, they could buy SpaceX, and they could buy Netflix, for $200 billion. They would do it. That's why that extra debt comes in handy. Does that make sense?
Yeah.
Cool. Thanks for your time. Seamus, you have a question?
I'm just playing League.
I'm banning you, dude. Anytime you come in here, we're gonna ban you.
Hi.
Hi.
Yes, calling from Puerto Rico here.
We kind of have a shirt policy that we tend to try to keep, but go ahead.
Oh, I'm sorry. No, I just had a quick question. I'm a huge finance geek, and the thing is that I realized that my mother actually has like $36,000 sitting, and she doesn't know anything about finance.
You have to. So if you call in and have a question about the 1.5 hour lesson that I just painfully put together, it would be very nice.
Can you link the Bloomberg website you were using?
Bloomberg software is you have to have a license to it. It's expensive.
Oh, okay. Thanks, anyways.
No problem. Hi, Bob.
Hi, is there a link anywhere to the beginning of the financial lessons so I can watch them in order?
Yeah, they're on my YouTube website. I don't think it's too hard to find.
Okay, thank you very much.
Sure, no problem. Thanks for calling.
Just go to Martin's stream and then click his YouTube link, and then it should pop up when he ends the recording and uploads it.
Martin, are you familiar with the Valiant Pharma?
Valiant Pharmaceuticals, yeah.
Yeah. So yesterday it was at.
Is this a question about the lesson that I just prepared?
Sir, I just got home, so.
Okay. So we just take questions on the 1.5 hour lesson, so we can make sure that the questions are related to the material. It's hard for me to answer off-topic questions. Hi.
When you were in that Bloomberg application, you were looking at the Apple investors.
Yeah.
If those top 2 or 3 investors were to get out, or if one of them were to sell, what would happen to the stock?
It probably wouldn't. It probably wouldn't change. I think that there's always a buyer in a market.
Yeah, that's what I never really understood. Because if you're selling stocks, there's always someone else buying them. So if big investors sell everything.
Well, I mean, if they're big enough, then sure. If Bill Gates sold all of his Microsoft stock, it would leave a mark. But eventually, the stock market would correct itself.
Okay.
Thanks for asking, dude. It's a good question. Yeah, try to stay on topic, specifically to the lesson. We can always talk stocks and stuff some other time, but the lessons are recorded.
So my question is regarding the lesson, but it's more so an investing question. So when you look at Apple's balance sheet, you obviously see a lot of cash there. So, I mean, when you're looking at the market conditions today, and since you're probably one of the kings of M&A, why wouldn't they be purchasing companies that are within their realm, you know, in terms of tax inversions and
That's a great
getting
question. Yeah, one of the problems with M&A is integration. You actually have to run these companies after you buy them, and that ends up being harder than it looks. You know, there are a lot of companies that tried that, like Hewlett Packard is a good example. They did a lot of M&A, none of it worked, because you have to like mesh these cultures, and it's just so difficult. Google is trying this kind of umbrella approach as well. It's just very difficult sometimes to run these companies as part of your own company. But I will say that I'd be shocked if Apple didn't make an acquisition at some point. The other thing is a lot of these big tech companies, they don't want to sell. So like Netflix is like probably the only company that probably would sell. But like companies like Tesla and others, it's very hard to get a friendly merger. One of the reasons I like M&A is I like to do hostile M&A. So I like to really pressure other companies with using especially psychological torture.
But what about like Apple buying a Fitbit? Maybe, you know, like maybe not as large as a company as Tesla.
They have to make the call. I mean, look, they bought Beats, right? They bought Beats, and they also, I mean, you have to ask Apple. You know, a lot of people have asked them that question. Why haven't you done any
Is
deals?
investor relations going to give me a good answer on that one, or
that's up to you. Sometimes a lot of people invest based on how nice the company is to you. It's not a good reason to make any investment. But you know, you have to, you got to think it through. It's a fundamentally important question, and we'll touch on that in other lessons. Is how do companies use their cash to make investments on behalf of their shareholders? And Apple, you know, they've been using their cash to buy back their own stock, which is doing something. So they're not just sitting there, you know, doing nothing with it. And they bought a few companies. They bought Beats. They bought, you know. But I absolutely agree. They should be doing. They could and should do something. I think.
But do you think in today's market, like in the volatility that's going on today, I feel like it's just too expensive for a company to be investing into other securities? So,
well, a company that's not their expertise either, right? So they can't.
Yeah, of course.
You know, Tim Cook doesn't know how to invest. You know, but if he sees an opportunity to acquire another company, it's just so hard because all these deals have to be done in a friendly way. They have to like actually, you know, sit down and hammer out an agreement. And these tech companies are so arrogant. That's why you never see tech mergers. You see pharmaceutical mergers like every day, but in tech, they always think they're going to be the next big thing. And look, Yahoo's for sale. So we'll see if Apple buys Yahoo. I doubt it. Again, one of the big things that happens in tech is the egos are so big that the tech companies never think that the company. They always think that every other company is beneath them. So like for Tesla, I think Apple said, you know what, we can make our own cars. We don't need to buy Tesla, and maybe it's true, you know. So in any event, it's you know, it's a great question. Let me see if I can grab another couple of questions before my date gets here. She's going to kill me.
So obviously, when you were looking at biotech stocks, the most important thing was looking at the drugs and how it was going to impact people and whether they'd be successful. So do you think with tech stocks, the most important thing is actually the tech, or with something like Apple, where it's kind of too big to fail at this point? Like, how do you really consider if it's going to grow?
Yeah, I mean, forecasting is forecasting. I think, you know, some of it you can see into the future. Some of it's trust and management and the direction they're going to take it. Some of it is what they say. If another example is, what if they put out a new product and it flops? Apple's flopped a few times. Apple TV, Apple Watch. iWatch was pretty fucking stupid, and it flopped pretty hard. So why should we trust Apple to release something more complicated, like an iCar? My guess is, you know, so that's my forecast. Your forecast could be, you know what, they flopped in the past too, and then they put out iPod. So, you know, it's everyone's guess is you have to make a reasonable assertion. What the stock market gives you, that's sort of the secret, and we'll talk about in Chapter 4 and Chapter 5. The stock market often will give you an opportunity to make a bet that is very likely to be in your favor, heavily in your odds. And if Apple stock goes low enough, the stock price is implying that the company will decline. And right now, Apple stock price is implying that they can't stay at this peak for this long. And that's, who knows if it's true or not. But the point is, if the expectations are really, really low, those are often investments you want to make. So in any event, we'll talk about that more in detail.
Question.
Hey, Alex.
Hey, how are you?
Excellent.
I've heard a lot of money managers, Buffett included, talk about the difficulties of running a fund when they have like exorbitant amounts of assets. Can you just elaborate on why some capital managers think it's hard to find opportunities when they have a lot of money to invest?
It's a better question for our next lesson because we didn't touch on portfolios or anything now. But certainly the more capital you have, the more difficult it is to make investments in small companies. The bigger the company, the more likely the stock price is going to be arbitrageable. The bigger the company, the harder it is to see an arbitrage. The smaller the company, the more likely it is to be misvalued. But if it's a $100 million company or a $1 billion company that's misvalued and you're running $500 billion, it's a little hard to make an investment in a $1 billion company. You basically have to buy the whole company. And even then, it's not material. So that's more or less the reason. Hey, Chris.
Hey, sorry to bother you again.
No problem.
So, would you, I mean, since this is a introduction to finance class for everyone here, it's hard to pick stocks, you know, and like you said, you might be 30% off either way. Would you just suggest indexing for, you know, your everyday retail investor? Because
Good
it seems
question.
like
I actually don't think stocks go up over a long period of time. So I don't think indexing makes any sense because I think stock markets don't go up over long periods of time. But we can talk about that later.
It's funny you say that because I have a graph from the Center of Research and Security Price from the University of Chicago, and it clearly it's called the big picture. It clearly shows that U.S. stocks since 1926 has been the best.
But why 1926?
I mean, I guess that's closer to the inception of the stock market, but I mean,
No, I don't think that's true.
You don't think so?
There have been stocks since the 1700s. There's a lot of that data. You know, I've thought about this. I've thought about this. Hold on. I've thought about this concept a little bit, right? I mean, I've traded probably $1 trillion of stocks, and it's not that clear to me that stocks go up over the long term. I think that I've seen all the same graphs. They're not inflation adjusted, right?
Well, no, it actually shows inflation below the U.S. So from 1926, inflation has grown to $16 if you invested $1.
And how about the composition of the indices? That's often a tricky.
That's a great question.
There's sort of survivorship bias in there.
Yeah, I guess they're going for blue chips, you know.
Well, even with blue chips, I think there's survivorship bias because what they do is the indices they just replace the losers. So there's a lot of kind of questions about it, how I'm not really sure stocks go up over the long run. And if they have gone up, even if it's over 80 years, it doesn't mean that they're going to retrace now to a central tendency. So I think there has been a lot of inflation of asset prices, and I'm not certain that we should readily accept that prices go up all the time. It's absurd. You know, prices go up all the time in real estate and stocks. I mean, what the fuck? Like, that, it doesn't make systematic sense that asset prices should have a general tendency to appreciate. Especially when GDP doesn't appreciate.
I agree, but so then how do you base asset prices? I mean, P/E,
cash flow, discounted cash flow.
Okay, that makes sense. That's a good point.
Yeah, but I love that kind of theoretical question, and just because I have a different opinion doesn't mean I'm right. You could be totally right, Chris. But next time, over the next several lessons, we're going to flesh this out more further, and I'd love for you to come back and really kind of discuss that because it's a really, really, really good question and something I've struggled with for over maybe even 2 decades on a theoretical basis.
Absolutely.
So
thank you.
Hey,
I think Phoebe was ahead of you. Sorry.
Okay, thanks. Question about quality of cash flow. Do you factor in the quality of cash flow from, say, something like recurring revenue from like an iTunes from Apple versus something that requires a lot more, say, intensive R&D, like a new product? Is that reflected in the overall discount rate of how you value it, or is there kind of a more specific valuation? Because those cash flows, I would imagine, aren't to be considered.
It's a great question. It's a fantastic question. So, like someone was asking me yesterday, what discount rate do I use for pharmaceuticals? The funny thing about pharmaceuticals is that you take them every day. Like, I've taken this drug for 20 years. It's called Claritin. I wouldn't say I can't live without it, but once you're a customer in pharma, you're basically a customer forever. You don't stop. But I've changed phone companies willy-nilly. So the thing about, like, there are definitely stickier assets that are just going to kind of live there and breathe there. And Apple's composition right now, I'm not certain we'll do this next lesson, but it's very heavily weighted towards selling hardware, and hardware is very finicky. I followed tech on and off for 15 years. Hardware is a little more finicky than software.
So you would probably apply a different value or quality valuation to that than the recurring revenue of an iTunes or an App Store.
And when you say quality of cash, typically when people say like quality of revenue or quality of cash flow, they're really dealing with like forensic accounting more than. This is like that term quality, especially in finance, has a very specific meaning. So I would avoid that. I would just call like I mean, it's certainly an appropriate word. Don't get me wrong, but like robustness or like recurring revenue is often what people say. Anyway, great question though. Really awesome question. Hey, Hunter.
All right, thank you.
Hey, I just want to say thanks for putting this on. It was extremely informative. I learned a lot. And what was the name of the book you recommended?
It's
so
called
maybe someone wants to read about investing.
It's called Common Stocks and Uncommon Profits by Phil Fisher.
All right, thanks. And what are some other books you'd recommend for?
It's in the PowerPoint. There's a bunch of them. Margin of Safety is probably the best one. Hey, Imran. Hey. I think your mic's off. You can try dialing in again later when your mic works. Hey, Hyun. Okay. He can just dial back in. Oh, I think I had muted him. Just dial back in. That's fine, dude.
Hey, Martin.
Hi.
I have a question. When you make investment in a company, do you consider a thing called PE ratio, which is price earnings ratio? I'll explain. Back to Apple, for instance, but that ratio, they are dramatically undervalued.
So PE is...
So, I mean, theoretically, if you invest now...
So PE is just sort of... we'll talk about PE next lesson. I don't think it's that important. I think it's just a shortcut for discounted cash flow, and you should focus on cash flow. Hey, dude, sorry to cut you off.
I wanted to ask was basically bonds are sort of more secure than stocks.
Yes,
are they?
Definitely.
They are more secure, but
typically
you would have much less sort of return.
Sometimes.
Okay. To stock.
That relationship is very complicated.
Okay. All right. So let's say for example, for youngsters who have a lot of time in front of them, they want to sort of take a bit of...
Yeah, we're not going to talk about kind of what investments you should make in any given point. The only thing we're focused on right now is just analyzing individual securities and trying to understand them before making any investments. Hi.
So when Apple hires software developers, is that part of the cost of goods sold or part of research and development?
Great question. I love that you asked this question. Accounting is pretty boring and difficult. It depends. So if it's a software developer for a new project, like an iCar or something, it would go into R&D. If it's a software developer that is putting an ad out for an Apple, let's say, website, that goes into SG&A, or selling general administrative. If it's a software developer that's working on their accounting system internally, again, SG&A. If it's a software developer for the iPhone itself, it could either go in R&D or cost of goods sold. It kind of depends. It's a good and tricky question. Definitely a tricky question.
Depends on what?
It sort of depends on what they're doing exactly, and whether the financial team thinks that person's work is part of the product. And it typically would not be. It would typically just go into R&D. But I could see on occasion that those developers would be a part of the iPhone. I mean, if it's not inside it, or it's not someone who put it inside it physically, it's hard to call it cost.
But like, what about like the iOS, like
people who develop? Exactly, that is technically sort of in there, and it was had to be made by somebody. So it does make sense that it could be a cost of goods sold.
Okay.
It's not worth, kind of twisting your mind around too much on it, but definitely software expense counts in cost of goods sold. I mean, it has to, right? But most, I would say 90% of Apple's cost of goods sold is going to be iPhone parts, glass, metal, transistors, chipsets, stuff like that.
Right.
So, great question, though. Hey, Dean.
Hey Martin, I have no question. Just wanted to say hi.
Cool. Hi.
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 Hello.
Yeah, you alright? Yeah, I was just
Yeah, I'm good.
I was just gonna say about like stock markets and stuff. What would you like recommend? So if I wanted to put some money in stock market,
So
just
only want to ask questions about the lesson, and we're not ready to make investments. We're just studying investing itself. Hi, Art.
For one of the next lessons, could you?
Quick question. What software do you prefer to use for charting? I'm so sorry, I didn't mean to cut him off.
Oh, it's okay. I don't really look at too many charts. I use Yahoo Finance or Bloomberg. Hi, Al.
Hey, so could you dedicate a few hours or an hour next session to day trading, or maybe the entire day to just day trading with like $10,000 or $50,000?
No.
I think that'd be really fun, and people would learn a lot.
Nope. My lesson plan is set for the next year. Sorry, dude. That is called gambling, I would agree.
Oh yeah, dude, day trading is a good way to lose a lot of money, especially if you don't know what you're doing.
Yeah.
Yeah, I do long-term investments, but biotech, man, as soon as like they started going after you on the news, everything took a shit. And so, when do you think it's a good time to get back? I know, it almost seemed coordinated.
It seems like a Steve Urkel moment. Did I do that?
Yeah, I know everything. I was like, oh shit, I'm down 10% on pretty much everything. I caught out quick. But when do you think, do you have a when
Did I crash the stock market? My bad.
I know, man. That would have been a good short, but. So when do you think is a good time to like a good safe time to get back into biotech? And do you think the presidential elections would, are really going to affect it?
I mean, that's a good psychological trading question. I don't know. I just buy stuff at deep value, When I make investments, I try to make 10, 20, 50 times my money. I'm not going to front.
So value-based trades.
Yeah.
When you do your research on the company, I mean, obviously you have a lot more insight than your average Joe as to wot's going on behind the scenes, but how do you get past the marketing nonsense and into really what's going on?
I think with experience, you kind of get a good bullshit detector.
Okay,
enough,
all right. Thank you,
experience. Anyway, that should be it for today. So I'll see you guys tomorrow, hopefully with a new lesson. If not, I'll just be around to chat some more. So stick around if you want. I'm going to open it up